Okay?
Yes,
Good
perfect.
stuff. So the essence of today's session is to briefly discuss the main financial statements. Why are we talking about that? As we all understand, we come from all sorts of countries, all sorts of walks of life, all sorts of industries. All of us come from different background at Hult. And when students come from all over the world, they will be learning various topics, various subjects, one of which is finance. In order to learn finance, we need to start at that sort of common basis, and we need to learn about the financial statements. We need to start with the basics of what financial statements are. We need to start with essence of how financial statements come about. And obviously, this is essential because at some point you will be working in management positions. When it comes to working in management positions, you'll have to learn about financial analysis. You'll need to learn about financial decision making. And in order to do that, you need to learn certain tools. All of these tools are of financial analysis, financial statements, accounting, and all of that. So in order to bring it all together and allow all students, those who have had experience in finance and those who have not had experience in finance, is to start, in common classes, in common financial analysis classes, the first one of which is accounting. So let me move over to a brief introduction of who I am, what I do at Hult. I would say I'm a typical example of a Hult faculty. Typical Hult faculty comes with sort of various attributes. Number one is that we are very much international people. We come from different backgrounds. We come from different countries, just like the students, and we come from different walks of life, different experiences, and so on. All of us, virtually all of us, are essentially professors of practice. There are few. If you look at various schools that are government funded and so on, you may discover that there's a lot of professors that are very academically inclined. At Hult, what matters is professional experience. As you all know, degrees like MIB, degrees like MBA, EMBA, these are all professional degrees. So students over the years, it's not just that it came from students, but it is all clear to us that what students look for is professional experience. So people like myself are typical examples of a Hult professor. We come from the industry, whatever that industry may be, and we specialize in particular topics. So where I come from, the finance industry, I spent a number of years doing investment banking. At some point, I was in business school like yourselves. I graduated from business school some years ago. I started working in finance, in investment banking, in a big major investment bank at that time, which was called Solomon Brothers. Today, it's part of the big group called Citigroup, with international presence. And I spent about 5 years with that investment bank, after which I moved over to the private equity industry. Private equity industry, as you probably know, has to do with deploying investors' money into companies, making companies grow, making companies profitable, making companies expand, and so on, and then hopefully providing returns for those investors. So I would be a typical example of a non-academic professor at Hult that comes from industry. So as you see here, I spent altogether about 20 years in finance, and then I started doing teaching. I started doing lecturing essentially as a pure hobby. At Hult, I've been teaching for about many years, probably at least 12 years now. So at Hult, I'm a veteran. I teach at the universities as well, as it says here, Cambridge University, Erasmus University in Holland, and a few other universities. So I'm a typical example of a Hult faculty of practice. So at the same time, I deliver courses to corporate clients in the City of London, as well as sort of on global basis. At Hult, I teach on various campuses. I am based in London, but I do teach on all of the Hult campuses: London, Dubai, Boston, New York, and San Francisco. So we have a number of professors that share their time between various campuses. As it says here, prior to Hult, I spent about 14 years in private equity, and before that, I was in investment banking. So that's in terms of my background. And as I said, it's quite typical to see this type of background with virtually all Hult professors, and when it comes to focusing on practical presentations and practical applications of the topics we learn. At Hult, way back when I started teaching at Hult, I taught only in the electives. Electives mean those courses you take in the summertime. You've covered your core courses in Module A and Module B in September and January, and then you would be doing electives courses in the summer. So I started doing that. That was many years ago. Since then, I've started also teaching some of the core courses. So if you end up in London, chances are you will be taking some of the accounting classes with me, and then maybe taking some of the finance classes with me. And again, on various other campuses, it is covered in a very similar fashion. So that's it. Experience before, the Hult has the luxury of bringing faculty from outside. And obviously, when they pick faculty to deliver courses, they look at professional experience. So that's in essence summary. Now, today I want to briefly talk about the essence of financial statements. I already mentioned why it is important, because look what we have on this little chart. The essence of it all is that at some point, when it comes to working in finance and in management, you will be doing some managerial decisions. You'll be taking decisions for companies to either adopt this project or adopt another particular project. Every company under the sun has a limited amount of financial resources, except, for the few companies in Silicon Valley that are very, very cash rich. All other companies have to always juggle with what they would like to achieve based on how much money they have. So the ultimate decision making is managerial decision. This is highlighted on the top of this pyramid. But before you could get to this, you need to start at the bottom. You need to first learn the language of finance, which is accounting. And as I mentioned, I do teach some of these courses in the core modules, and there are several other professors who do that on various other campuses. And once you've done, so this would be absolutely a core course you'd be taking. This is the #1 finance course you'd be taking at Hult, which is financial accounting. After that, you would also be taking another course called financial management, sort of a simplified form of financial statement analysis and so on. So Module A would be accounting, Module B would be taking financial management. So, slowly building up to certain financial decision making. In order then to work on those, you need to be able to do the essential elements of finance, which is forecasting analysis. Every project companies need to adopt, they need to adopt based on some visibility of what the project is going to produce in terms of upside for the company. So forecasting, historical analysis, future analysis, as well as valuation. Any project companies adopt need to be analyzed in terms of whether they bring value to the company or not. Otherwise, perhaps it's not wise to adopt a project. So forecasting and valuation analysis builds on financial management, financial statement analysis, and all of this builds up to what the essence of it all is managerial decision. Good, so that's really why we do that. Now let me dive into some of the financial statements that I wanted to briefly talk about today. As it says right here, financial analysis is the evaluation of current or past performance in order to take certain decisions, okay? In order to take decisions. So now, in order to help you with this, you need to understand what are the three main financial statements. Some of you already are probably quite aware of what these financial statements are, what are they, why are they important, what do they tell us, and so on. So here on this summary sheet, we speak about those three financial statements, the essence of it all, which is one, the balance sheet, number two, the income statement, and number three, the statement of cash flow. So the purpose of this presentation is to put some meat onto the bone onto these three bones. What is a balance sheet? What is income statement? What is cash flow statement? In your accounting class, if you come to Hult, the first accounting course you'd be following would give you tools to create these things. The end game in an accounting course is to start from scratch in terms of financial information, start from the basic financial information you may get about what company is doing, and then be able to produce company's balance sheet, company's income statement, and the company's cash flow statement. That would be the end game. Once you have those, then you can proceed further into the analysis of what that information in front of you tells you. Good. So number one, let's speak about balance sheet. Balance sheet, what is a balance sheet? Balance sheet, to borrow a basic language, is a list of what company has in terms of assets. I'm sure we're all familiar with what assets are. In many instances, at the beginning of the course, I ask students to give me examples of assets, and they all are able to come up with this. What is an asset? Assets are the things that companies use to deliver upside. So what is an asset? Could be cash. An asset could be a building. An asset could be a piece of land. An asset could be a productive facility. So that's typically what an asset is. Most students are able to give examples of assets. But then I ask them another basic question. Is it good to have assets? And right here, we already come to some sort of a confrontation with some of my students, because typically when I ask students, is it good for companies to have assets? The show of hands always is, yes, well, of course, it's good to have assets. Well, the answer is actually no. Assets are not there because companies are in the business of producing assets. Typically students who tell me that assets are good, they obviously speak from a personal perspective. It's nice to have a house, it's nice to have a car, I would love to have a swimming pool, etc., and so on. So people always think from this personal utility perspective. For a company, for a business, it's different. If I could be selling, high value products from the back of my garage, that would probably be the better business instead of a business that has a lot of assets. So from a company perspective, assets is not what is good. Assets is what is necessary. Otherwise, you may not have a business. So the way we want to think about assets for a business is not that it's some sort of a luxury. Assets are necessary. Without assets, you may not have a business. And as you know, some businesses are very much asset intensive, and some businesses are not intensive at all. Services, for example, these are businesses that are not very asset intensive. Services typically sit in an office, have a lot of, consulting employees, and that's the type of business they provide. They don't produce things, they produce services. So perhaps businesses that are in the service industry are not very asset intensive. Businesses that are in production industries like car manufacturing, or another good example, mobile businesses. Mobile businesses like Vodafone and others, They spend a lot of money on assets because without those assets, they wouldn't have a business. As you probably know, all mobile businesses of today spending a lot of time and effort putting together 5G networks. Those networks are expensive. These are assets that are necessary. Without these assets, you don't generate revenues, you don't have a business. So we want to think about it, assets, in terms of is necessary to run a business as opposed to some form of luxury of sitting on assets. So assets are the first element, as you see right here on this little equation. Assets is what the company owns in terms of having a base on which they deliver revenues, they deliver services, or deliver products. On the other side of this equation, we have what we call liabilities. Liabilities, in basic, Brooklyn English, so to speak, is what you owe to others. So assets is what you own. Liabilities, it's a form of debt. Liabilities is what you owe, and at some point you'll have to give back. Somebody will come and try to collect those liabilities. So if you do have assets, and if you do have some liabilities, you can already right here, you can imagine that if you have more assets than liabilities, well, the result is what we call equity. Equity is any type of leftover upside for shareholders. Shareholders have positive upside in a business if the business has more assets, if the business owns more than what it owes. So there you have it. In lecture number 1 in accounting, you will come to this fundamental accounting equation, which says assets must always equal liability plus equity. And a lot of students typically struggle with the name, what is equity? Simply think about what I own versus what I owe, then I have some equity left in a business. A typically good example to think of equity is to think about a house you bought. You bought a house. If you bought a house with cash, well, guess what? You have the house and you don't owe any money. But if you bought a house with a mortgage that you took out from a bank, then obviously you owe some money to the bank. The equity value in that house would be the value of the house minus what you owe to the bank in terms of mortgage. That would be equity. So we, in financial statements, in accounting, we speak about the balance sheet sort of as a fundamental cost and fundamental description of what the company has with which to produce upside for shareholders. Yet another example of what a balance sheet looks like, I like to sort of use an example of the fastest man on earth. You all know who the fastest man on earth is. That's Usain Bolt. So let's look at Usain Bolt as our example of a company. What would be his balance sheet? Well, the balance sheet of Usain Bolt is the muscle. That would be the asset. The liability would be that, whatever, he still has a little bit of fat on him, like we all do. So there you have it, the muscle minus the fat, and then the rest would be equal to that equity leftover upside. So typically the balance sheet of Usain Bolt is the muscles with which he can run. That is the balance sheet for the company. Okay, so that is the basic description of what a balance sheet is. Here we have a summary of what I just said. What the company owns is on the asset side. What the company owes, one thing to remember about what you owe is that somebody will always come and try to collect what belongs to them. Some European governments forgot about that. They borrowed a lot of money over the last recent years, and then they forgot about the fact that they will have to pay it off. So that is an issue, Europe, political issue, economic issue, and so on. But what you own versus what you owe, and then The delta between the two would be the residual upside in the company for shareholders. So going backwards and forwards on this equation is the beginning of the accounting class that you would be taking at Hult. Here we have, again, what I already mentioned, definition, something that you own in order to produce upside for the business. It could be an office building, production equipment, supplies, cash, things like that. Equity is the leftover upside. And we already spoke about the liability. Now, limitations of this balance sheet. How do you put together a balance sheet? You have to put it together based on certain rules. So obviously accounting is not just going through all these rules, it's to understand of the process of putting together financial statements. But yes, just like any language, when you write in a particular language, there are rules. There's the verbs, there's the nouns, there's adjectives, prepositions, and all of that. There are rules when it comes to putting financial information in accounting. And because these are based on rules, nothing is perfect. Obviously, these rules are supposed to be to the best, ability of deriving certain rules. But there is no perfection in accounting. Accounting is not perfect. Accounting is a set of rules put together by accounting experts all over the world, which is supposed to help people read financial statements in a particular way and understand it. So balance sheet does come, accounting comes with certain limitations. Information that's provided on the balance sheet comes with certain limitations. And then obviously, as you may know, some people produce financial statements in some sort of a conservative manner. Some people put it together in a more aggressive manner. That's why we have these rules. We also have, the job of an auditor that is supposed to oversee all of that. So balance sheet is not perfect. Let me give you an example why accounting on a balance sheet is not perfect. Some of the things that company owns do show up on the balance sheet. Some of the things company owns do not show up on the balance sheet, simply because the rules tell us that they do not belong onto the balance sheet, and or we're not allowed to put it on the balance sheet. So there are certain limitations that you need to be aware of it. We do go through during the accounting class. Balance sheet also needs to be presented in sort of a user-friendly manner. So typically balance sheets are presented in a classified format. That is a legal prescription. If you're a public company just about anywhere all over the world, balance sheet must be presented in a particular fashion in order to allow people to read it in the most friendly, easiest possible way. So there is this classification to how information is presented on the balance sheet. Typically, number one, on a balance sheet, we would be putting together what we call current assets. Current assets are those that are either cash, expected to become cash within 12 months period. As you know, there is different levels of assets. Some assets are more liquid, some assets are less liquid. Liquidity means how quickly I can convert it into cash. Typically in finance, you will notice that, what is gold? Gold is cash. If company is sitting on a lot of cash, the company, you may say, is safe. So how much cash company has is very much important to financial managers, and or how quickly company can turn financial assets or any assets they have into cash. So that's why the first section in a balance sheet would be called current assets. Current assets are, as I said, cash, cash equivalents, and so on. After that, we will have other sections on the balance sheet. Another big section on a balance sheet would have to do with property, plant, and equipment, those immovable assets, physical assets, production facilities, buildings, land, those items that are not easy converted into cash, those items that are essential to a company producing financial upside, but those that are not easily convertible into cash. So they are listed separately exactly for that reason, so that users of financial statements can quickly see that, aha, these are not financial assets. These are not easily convertible into cash. They are there for another reason, to produce things, whatever company may be selling, but they need to be classified as separate assets. And that's a prescription. Next, in terms of other assets companies may have, some of you may know it, some of you will learn about it for the first time. Some assets are what we call intangible assets. Intangible assets have no physical presence. So intangible assets are all of those assets you cannot walk up to and touch, but we know they're assets. So things like copyrights, trademarks. There is incredibly strict classification and set of rules about what could be presented on the balance sheet as intangible assets and what cannot be presented. Again, I already mentioned balance sheet has certain limitations. Think about it, pharmaceutical companies right now. A lot of pharmaceutical companies are now working heavily on developing a vaccine for COVID. And they're spending a lot of money on research and development. You know, accounting rules, essentially, as it is today, accounting rules do not allow any money that you spend on research be classified as assets. And there are certain reasons for it. There are particular reasons for that. But money that companies spend on current development, exactly a good example is to think about a major pharmaceutical company like Pfizer or somebody else like that. All the money they spend, I mean, pharmaceutical companies, they're almost exclusively about research and about development of the next generation drugs. None of that money spent on pharmaceutical research can be shown as an asset until at some point they have developed a particular drug and they have proven that that drug is functioning and working and so on. At some point, you may be allowed to put some of that money as an asset on the balance sheet. Is that a problem? Is that not a problem? You know, it's a debate. Some people say, it's not a problem. Some people say it is a problem. We should be able to show it as assets and so on. So again, strict rules about what can be shown as intangible assets. Good. Now let's talk about liabilities. Same story. Logic should apply. Liabilities could come in the form of short-term liabilities and long-term liabilities. And again, remember what we said, a liability is what you owe. So typically we're talking about financial liabilities. If you borrow money from a bank on short-term basis, and you're gonna pay it back within 6 months or up to 12 months, well, that will be listed as current liability, such that users of financial statements can immediately see that you're gonna pay it off within a short period of time. Longer term liabilities, those that you're gonna pay off in 2 years, 3 years, 5 years, 10 years, 30 years. You know, there could be any type of long-term liability. Sometimes companies issue bonds. Sometimes companies borrow money long-term. Think about Boeing. Boeing borrows money on very long-term basis because, as you probably know, developing an aircraft, that's a multi-year proposition. So they typically try to match, you know, how long they have to pay it off to when they expect revenues to be generated from a particular research project. So long-term liabilities, longer than 1 year. Mortgages would be longer than 1 year. Anything that you owe on current short-term basis would be listed as current liability. And then finally, the leftover The difference between assets and liabilities, I already mentioned, that would be equity. We don't need to go into the details of it, but there is certain classification here. All we need to remember that the difference between what you own and the difference between what you owe would be listed as equity. Here's a little example of a balance sheet. As you see, on the asset side, total number of 600. On the liability and equity side, total number of 600. At any given point in time, this equation has to hold. It always has to be in balance. If it's not, then that means there's been some sort of an accounting mistake. So obviously it's not, it has to be. That's the way, because we typically do double keeping book entry. This invention of double entry bookkeeping, this is not recent invention, whether you're talking about the GAAP accounting standard, whether you're talking about the IFRS accounting standard. There are two global accounting standards. Either one uses double entry bookkeeping. This is historical. It was developed in the 14th century in Italy. So this is an old double entry bookkeeping accounting system that was developed many years ago, and it's still being used today. So we don't need to go through the details of what we have on this balance sheet. Here's a little example, but the fact is that the totals between the two columns must always be equal. What you owe minus what you owe is the leftover value. Good. Let's focus now on the income statement. Income statement is now, what is an income statement? Income statement tells us about performance. So think about, I already mentioned, balance sheet is the muscle, the neck muscle on Usain Bolt. What would be Usain Bolt's income statement? Usain Bolt's income statement would be his performance, how fast he can run. That's why he's using those muscles. So income statement talks to us, tells us about the upside that the company is generating. The company is supposed to generate upside for its shareholders, for its owners, and revenues minus expenses. That's typically what's listed on an income statement. So income statement, one of the main statements, tells us about performance. So the achievement of Usain Bolt, his records and so on, that would be the performance. And typically on the income statement, we have a list of revenue items, what the company generates in terms of upside against the costs, which the company has to spend money on in order to generate those revenues. Similar to balance sheet, income statement comes with a list of limitations. Nothing is perfect. Some of the accounting rules have an impact on how financial information is presented in an income statement. So income statement is all about performance. Income statement, just like balance sheet, has to be put together based on certain rules. There is a classification on an income statement, just to allow users of an income statement to quickly understand what the essence of that business and performance is. So typically an income statement would be classified into a couple of sections. Number one, we would call it an operating section, which in basic English means your core business. If you're an airline, your core business is to generate revenues from flying people around. If you are a mobile business, your core business is to provide mobile services and so on. So that would be your core business. All revenues against all expenses would be listed in this operating section. But then there's also a few others, non-operating. Some companies have secondary activities. They may be doing mostly this, but they are also doing something else which is not part of the core business. But if they are engaged in some other activities, they would be listed on a separate section. such that users of financial statements would understand that this is the core business. This is also some upside from non-core business. Next section on an income statement would be the taxation. As you probably know, in most countries, you will have what we call corporate tax. The government takes a chunk of the difference between revenue and expenses. So most incomes are taxable. Some countries have a higher tax rate. Some countries have a lower tax rate. You know, some countries have a zero tax rate, like we still have a zero corporate tax rate in Dubai, or is this about to change as well? But there is this section called income tax, just to classify and list what companies spend on taxes. After that, you may have another section called discontinued operations. All of those operations that the business might have exited. Think about Tesco. Tesco is a big retailer in England, and a few years ago, they decided to make an investment into the US, and it didn't really work out. So at some point, they had to shut it down. So that would be listed as discontinued operations. So there's a logical classification on that income statement called performance. Income statement is very important. As you classify the income statements, revenues and expenses, you could look at certain metrics, how the income statement is expanding from year to year. Would be one analysis, typically what we call historical analysis. And you could also look at margins. You could look at various margins on that income statement in terms of percentages. And when you look at the margins and percentages, you can then compare a particular company A with another company B. You can compare performance. So these margins are very, very much important. So typically you would have revenues minus some core expenses, net it all out, would get what we typically call gross margin. Then you would have other costs you would net out. It's all flowing and following a particular prescription of how we produce it. Then it would, by the time you would net out all the operating expenses, you would end up with what we call EBIT, earnings before interest and tax. Below that, you have interest and taxes. And finally, the bottom of the income statement would be that what we call net income. Net income would be operations. Here's a little example of how we would analyze margins on an income statement. Think about a company here. Let's look at this company. Company generates $100 of revenues, and it has $70 of costs. Costs of COGS, what we call cost of sold, direct costs. So margin on this would be 30%. Then there would be other non-direct costs, sales, general, admin costs. And then we would then net it all out. We have what we now call earnings before interest and tax. Then there would be some sort of a depreciation charge. Operating income netted all out would be $12 or 12%. Look what happens when company expands revenues by 5% and everything expands in proportion. Magic happens. When you expand everything in proportion and your fixed costs are staying fixed, your margin expands at a higher rate. So when revenues expand in proportion and all the variable costs expand in proportion, your operating income expands at a higher rate. So no kidding. When it comes to producing financial reports, every quarter companies pay particular careful attention. They always try to manage the levels of cost. They always go after the expansion of revenues and hopefully trying to keep the costs, because at the end of the day, shareholders are rewarded, or managers are rewarded for not how much they generate in terms of revenues, but what it means to produce in terms of bottom line. So there's a little example on that. Now, the last final statement I would like to spend a few minutes on is what we would call a cash flow statement. Cash flow statement is the third critical financial statement. Balance sheet is about the assets. Income statement is about performance. But what kind of performance? Economic performance. Here's a little question for you. I'll give you the answer. If you sell for cash, did you sell? Yes, you sold. If you sell on credit, did you sell? Well, economically, you sold. So that information will be listed on the income statement. But what if you sold and then you failed to collect? So critically, you can clearly see how critical is what we would call a cash flow statement. Cash flow statement is a statement that translates economic performance from an income statement into the calculation of actual cash that the company may be generating. Performance, economic performance is very important. But unless you collect any sales you make on credit, people do sell on credit. Why do they sell on credit? Well, because if they didn't sell on credit, maybe the customer would go to competition and they would lose revenues. But what is critically important is that at some point you translate economic performance from income statement to what we call a cash flow statement, and the statement which actually shows the ins and outs of cash of the company. You may generate great performance, and if you fail to collect, if you sell too much on credit, if you invest too much in inventory and you do not collect revenues in terms of cash, you may go bankrupt. So that's the process of converting an income statement into a cash flow statement, typically the most complex of the financial statements. We do go over that in the accounting course. You have to learn how to put together a cash flow statement based on an income statement economic performance. Essentially, in terms of economic performance, cash flow statement is a process of cleaning up the income statement and translating economic performance into a cash performance. Economic performance is one thing. It tells you about the sustainability of the business. It tells you about whether the company is doing a good job or not. But then the essence of a CFO, Chief Financial Officer, would then be to try to convert economic performance into a cash performance. So companies pay particular attention. There is a concept in finance called growing bankrupt. Companies that are growing very, very fast could very easily go bankrupt because they are selling a lot on credit, because they're investing a lot into operating assets, and therefore they may not be collecting revenues in time. An excellent example of this is a company by the name of Dell. You know Dell. Today it's called Dell Technologies. At the height of its growth, about 20 years ago, the company was selling computers and laptops like hotcakes. And it's only later that the company's CFO admitted, at the height of our growth, we were 2 weeks away from bankruptcy because we were growing so fast and we did not pay almost any attention into trying to convert economic revenues, economic sales into cash flows, into cash revenues and cash sales. So that's a good example. That's enough said about a cash flow statement today. It is a very important analysis that has to be done in accounting and in financial management class to convert income statement into a cash flow statement. So if I was to ask you which one of these three statements is the most important, well, the answer would be all of them. They all give us different financial information. Balance sheet tells us about the assets. What is the asset base? which the company is using to derive performance. Income statement is the economic performance itself, and the cash flow statement is our ability to generate cash into all of that. So as a last example, we spoke about Usain Bolt and his muscles being the balance sheet. His ability to run would be the income statement. Obviously, do you think he makes money out of that? Yes, the cash flow statement would be the upside that he creates financially for yourself out of his performance. Good, I will stop here. If you have questions, please let me know. I'm happy to answer questions you may have.